Hi, everyone, and a very warm welcome to this special edition of Money Control Markets Weekly. This is the time when we catch up with all our viewers to sum up the entire weekly action and also talk to our guests about what lies ahead as far as the equity markets are concerned. Today, we have Mr. Mahantesh Sabarad joining us from SBI Capital Securities. Mahantesh, thank you so much for taking time out.
Thank you, Karunya. Good afternoon, everyone.
Well, I'd like to start with how the markets panned out this week. It was definitely one of those not so exciting and slightly lackluster sort of weeks as far as the benchmark indices are concerned. You had both Nifty and Sensex shutting shop with a bit of a downtick. Tell us about what really stood out this week for you in terms of market action. Of course, we saw the earnings season kickstart with TCS reporting its numbers yesterday. But what else were the key driving factors for you?
So, this week we also had these observations related to the markets from the global perspective, wherein the dollar was strengthening quite a bit. This comes from the backdrop of a few weeks ago when Fed started talking about raising rates sometime in FY23. So the lackluster market activity that we have been seeing this week is a fallout that has come about from the Fed's action to subsequent small pullout by the FIIs, and we had certain developments with a few stocks, such as in the auto space. We had the auto monthly numbers being announced. We had a profit warning coming in from the likes of Tata Motors. And as you mentioned, we also had TCS announcing their results. So the market has been uh, taking cognizance of all these things, and therefore, in a way, we have been seeing a lackluster market, something which is bereft of any triggers right now. So we think that this trend of consolidation that is happening will continue for a while in the markets.
Right. And as you rightly nudged me towards Tata Motors, well, that definitely was the talk of the street last couple of days. Profit warning coming in from the luxury car maker JLR definitely, weighed quite significantly heavy on the stock as well. And as we all know, you've been tracking Tata Motors very closely. You've got some very interesting insights for us over the last many years now. So tell us, how should investors read into this development? Of course, chip maker shortage impacts not only JLR, not only Tata Motors, but several other car makers as well. So now that JLR has sort of stuck its neck out and given a profit warning, will others also eventually follow suit?
So surprisingly, we have not noticed others really talking of such large profit warnings as Tata Motors have indicated in their JLR units. There are other German companies who compete directly with JLR on the luxury car market side. We have seen certain amount of noise coming from them in terms of chip shortages for several months so far. But this profit warning by Tata Motors is quite surprising, because they're talking of something like unable to meet 50% of the demand in the upcoming quarter two, which is quarter two of fiscal year FY22. It's a large number. We have seen other car makers talking of productions curtailed by 2% to 5% to 10%. They've not talked of some 50% kind of warning in terms of volume. So this is quite unusual that is coming from the JLR end. And this profit warning, mind you, is not just for quarter two alone. By the way, it's also a warning that they've sounded for the already ended quarter one in terms of sales. So
Yeah.
it's quite surprising from the that Tata Motor is warning such.
And this is more shocking or more negative also because it took them a while to sort of turn around their JLR business to come back in the green. And once again, there are these worries with respect to chip shortage, which could dent their volumes, their production, and not only for Q2, but even beyond that, they could see some effect. Given the fact that the stock has cracked, 11 odd percent, do you think investors should buy this dip, or should they wait, perhaps because one doesn't know what's in store for Q1 as well, since they have seen an impact even in this quarter?
So I think this dip is definitely temporary.
Well, I think we seem to have snapped that line with Mahantesh. Perhaps we got him on a bad line. We'll have to get him back into the conversation. We'll just take a couple of more minutes for that. But just to put things in perspective, what really has transpired with Tata Motors, because given various initiatives over the last many quarters now, whether it's Project Charge or several other steps taken internally by the company to turn around the business, to turn the free cash flow positive, and to sort of cut their losses as far as the global operations are concerned. They have finally started to show some positive benefits and impact of that. But once again, with this profit commentary that they have given, caution that they have raised as far as their profitability is concerned, because of this chip shortage, they could once again slip back into the red, and they could see a significant dent as far as their free cash flow situation is concerned. So that definitely is something to watch out for as far as Tata Motors share price is concerned. In the last 1 week, like I said, the stock has come down, crashing 11.2%. So that's quite significant. Okay, I think we have Mahantesh back on the line with us. Um, Mahantesh, welcome back. I think you seem to have lost the internet connection, but now that you're back, would you like to step into this views that you were sharing with respect to Tata Motors, whether investors should buy the dip, or if they should perhaps wait and see how Q1 pans out?
So I was suggesting that this is not the time to buy the dip because you will remember that there was a significant rally that we saw in the Tata Motors stock, particularly closer to its annual result announcement, and that rally continued even further thereafter, because the company came out with a very strong guidance talking about JLR being delivering 4% EBIT margins, better cash flows, and so on and so forth. And it came from the backdrop that they'd already taken restructuring costs in the quarter four results, so cleaning up their balance sheet quite a bit. This time around, the profit warning that has come in is quite surprising, because it's within just a matter of few days that they talked of chip shortages in Q1, and that continued into Q2. This is seemingly very worrying trend, and I have my doubts whether the company will be able to meet their 4% EBIT margin even now. So it's better that one takes informed view and await further numbers from Tata Motors, particularly the Q1 result announcement.
All right, but what about the overall earnings picture? Because we've been talking about it. In fact, perhaps the markets also, to some extent, seem to have factored in that Q1 performance across the board will see some amount of weakness. So, tell us a bit more about what your view is, and are there going to be any outperformers that you will be betting on?
So you have to remember that we've had a devastating second wave, particularly hitting the country during this period of April, May, and that's been an earnings dampener for many of the companies. Although from a year-on-year perspective, compared to the previous year, we've had better performances getting delivered by the companies. Nevertheless, what the market seems to be observing right now is what is the quarter on quarter kind of trend and not a Y kind of trend. The quarter on quarter trend seems to suggest that we will have an earnings dip by most of the companies, something which we saw in the case of TCS already when it came to their India business, India centric business. Although TCS delivered better numbers from a global perspective, from an India specific perspective, TCS numbers were subdued. That's an indication that we will not see good earnings quality coming in from Q1 onwards, and potentially in Q2 the earnings visibility will be even poorer. Mind you, there is also one factor to consider is that while the IMD came with a forecast that said monsoons will be normal or slightly above normal
Hmm.
this time around, we have seen that the country is currently facing a deficiency in terms of the monsoon. I think the deficiency numbers I have not seen it, but it's somewhere in the range of 40% already. It's early days to talk about monsoon deficiency, but I'm sure IMD will be lowering the forecast when they come up with a new number later in the month.
What about the IT pack? Because of course, as always, IT starts releasing their quarterly performance report the first, and we already have TCS, which was I think a bit of a soft quarter. Tell us about how IT space is likely to play out, because even if you look at the stock price, many of these heavyweights have been a bit sluggish over the last couple of months. It's only in the recent past that they started to sort of witness some positive action.
So generally, we are very positive on the IT sector simply because of one big reason. See, IT companies have deal wins that typically happen every year. We have seen in the past that the average deal win growth is in the 7-8% range, kind of. But this time around, we have seen that most of the IT companies have reported deal wins in the range of 15%. Now, these deals are multi-year deals. It's not pertaining to specifically FY22 year. These deals are spread over multiple years. So, with this backdrop of high level of deal wins, most of the IT companies will stand to gain and do better. There's also an outside chance now that the rupee is depreciating with respect to the dollar, that their earnings quality in terms of margins will be slightly better. So most of the IT companies, from a global perspective, we believe will do better, report good earnings, and most of the mid-cap IT names will report stronger earnings this time around, because we have seen strong global recovery, particularly in the US. Most of the IT companies are US centric, not necessarily Europe centric. So that tells us that the quality of earnings from by IT companies will be strong. So on a relative basis to the markets, IT companies should outperform, is the belief that we have.
Are you equally optimistic about platform companies as much as you are to these IT service providers?
See, platform companies are something new in terms of their business growth and opportunities right now. So from that perspective, most platform companies will do well. But I'm very unduly worried about the valuations that some of these platform companies are commanding. It comes from the backdrop of what Reliance did with Geo platform. So not every platform company is a Geo platform. Geo is too large relative to any of the others. So valuation is a concern. Business is not the concern that we have. Just to give an example, Tanla Solutions, which is becoming one of the favorites in terms of platform companies for most investors, has been a disappointment from a performance point of view. 10 years ago, the net worth was 930 crores. Today, it's still 900 crores, 10 years down the line. And the stock is like 50 times up in this period. Something is really wrong in terms of valuations for these companies.
Right. What about the metal index? Once again, we're witnessing a lot of traction and a lot of buying that's taking place in the metal space again. Of course, a huge deal of it is responsible or is because of what's happening in China and the kind of regulatory developments that are happening there. But do you think that this, this appetite or this demand for metals will continue, despite all
I
the
think
run up that we've seen?
I think there is still room for expansion for most of the metal companies. The perspective that you should be having is that most of these metal companies have to be viewed from a conversion angle point of view. That means, irrespective of the cost structure that they may have or pricing cost structures, as just when commodity costs go up, raw material prices to go up. But the conversion factor that most of these metal companies have is now getting favorable. Part of that reason has to do with inventory control that is being exercised in China over a period of time. Excess inventory, particularly on the steel side, has been coming off because the production has been poorer. When we have therefore lower production, lesser inventory, capacity utilization of existing players or financially strong existing players becomes better. Their ability to command better prices goes up, and their conversion margin therefore rises. So most of the metal companies will continue to see that trend for in the foreseeable future. And irrespective of what happens in China. So we believe that many of these metal companies still have room for upside. From a valuation perspective, you should remember that these companies were highly indebted, and over a period of time, they have cut down their debts to by a large extent. When a company cuts down their debt by such a large amount, it obviously reflects into the market cap growth without the valuation number really growing. So most of the metal companies therefore seem quite positive to us, even at the prices that they command right now in terms of share prices, despite the strong rally that they have witnessed.
Right. Uh, but what, according to you, is a good buy right now? Of course, many of these sectors and individual names have run up quite a bit. So tell us, where is value at the current levels?
So I think we did discuss over this period of time that we see value in IT companies. Reason number one is simply the large deal wins that they have been garnering, and there is potential for these deal win growth to accelerate even further. So IT companies, particularly in the mid cap IT space, is something that we like. We particularly like these metal companies for which I just mentioned that the conversion margin is expanding and will continue to expand according to us in the foreseeable future. Uh, and if I were to pick any other names, it's particularly in the chemical space because there's been a conscious shift that's been happening over the years, and it's not a phenomenon limited only during the pandemic year. It's several years that the chemical industry is doing relatively better. It's gaining market share relative to the Chinese chemical companies. So you have to you have to pick some good chemical companies along the way. So these are the pockets of value that we see: IT, chemical space, metals right now.
What's your stance on the banking space right now? If one wants to sort of look into owning financial stocks, should they be looking at lending services? Should they look at banks that have more retail exposure vis-a-vis corporate? Any view on that front?
So when it comes to the banking space, the one good thing that we have been able to see is that the NPA trend has been favorable. That means the NPAs have been coming down. Part of the reason also has to do with forbearance coming in from RBI and support being given by the government in terms of credit guarantees for certain sectors. The moment you pull this out, that means when you pull the government's incentives, when RBI becomes hawkish, already there is an expectation that with rising inflation, RBI will need to become hawkish, will need to raise rates. In such a situation, banking stocks may not necessarily do well. We've seen that PSU banks have actually done well, both in terms of their financial performance as well as from a stock market performance. And even from a valuation perspective, they do not appear very expensive. They are tending to be expensive. So there is limited room available for PSU stocks or PSU banking stocks to do well in the upcoming months. But
I
this
think
is
we
within
once
that
again
segment.
seem okay. Mantesh, am I you getting my audio right?
Yes, yes, I can.
Okay. I thought we snapped the line with you again. All right. Never mind. Keeping it with the PSU space, you've talked about banks, but overall, given the privatization trigger, where do you think PSUs are headed? Is there any kind of value or any interesting businesses that you can identify within the PSU basket?
So, within the PSU banking space, yes, privatization is a move that is really happening. But prior to that privatization, there needs to be a lot of capital infusion that needs to happen in many of these PSU banking names. Probably, if the privatization move is accompanied by a capital infusion move, the banks, PSU banks, can potentially do well. So there are very few such names, and I would rather pick the middle rung PSU banks than the top PSU banks for this, who seem to be doing better. Many of the PSU banks have an advantage of a very strong liability side of the balance sheet. That means their network presence, their spread, their clientele is typically very rich, very strong. And while they may have problem on the asset sides in terms of delivering numbers, the liability side is what is more attractive when it comes to privatization. So the mid-run PSU banks can potentially do well if the privatization move is concrete and accompanied by a capital infusion.
Okay. I'm just looking at some viewer comments as well that are trickling in. One of our viewers has asked, RBI published a report that Indian markets are overpriced and there's a bubble in the market, whereas JP Morgan published a report that Indian markets will rally for the rest of the year. What is the truth? Can you give them a picture of what's going on for those who are, uninitiated?
So, one of the measures to look at when it comes to markets is the valuation metric. And you may not have the forward valuation metric with you because you, as a simple investor, may not necessarily be well conversant with the earnings outlook and forecast. But it's useful to look at the past valuation metric. And if you were to plot the trend of the Nifty valuation alone over the years, take a 5 year period, take a 10-year period, whatever it is, you will notice that the peak valuations actually hit the market sometime in February this year. We are in July. We are something like 5 months away from that February peak mark, and the valuation has collapsed. One of the reasons for the valuations coming off is the earnings have been becoming better, because what is valuation finally? It's price upon earnings. So while the price, which is the Nifty level itself, is very high, the earnings is going up and up and up, which makes the market really therefore attractive. So if RBI is saying that there is a bubble in the market, probably their sense is got to do with the price itself, price level itself, and not really the valuation metric. To me, it is very simple. The valuations are not expensive. It's the peak valuations hit us in February, and it's come off quite a bit. And every successive quarter, the earnings quality will be better and better because we are recovering from a pandemic low. We are recovering from a pandemic low.
Hmm.
So I would tend to believe that the markets are therefore not very expensive. There's trouble in the markets right now.
Okay, I hope our viewer is taking note of that. Another viewer who's just tuned in is asking your outlook on the sugar stocks. Are there any favorites within that space?
Sugar is a highly controlled sector. There are
Yeah.
controls that the government imposes on sugarcane prices, on sugar prices, on exports quota, on levy quota. All these things exist. There are too many controls for the sugar sector. The only two things that are now working favorable for the sugar sector is number one, the export of sugar out of India is growing. There's been a large export quota that has been released recently, which makes
Hmm.
the business outlook for sugar companies better. The second piece of good news for sugar companies is that ethanol production, which is a byproduct of sugar companies, is becoming a lot more lucrative. Although there are problems in terms of ethanol being lifted by the oil companies, it's on a low key, it's much below target.
Hmm.
But the outlook for these two reasons remain better. But but these two reasons shouldn't make you very gung ho about the sector because the other set of restrictions still exist, and therefore we are not very hopeful of the sugar sector, especially when the prices of most of the sugar companies have already risen.
What about the IPO space, the primary markets? We get a lot of questions when it comes to that. Of course, July is going to be a record month. We have about 10 IPOs lined up, and with big names like you have a Zomato, you have a Glenmark Life Sciences, and among many others. Um, which are the more exciting businesses within these? Any debuts that you're looking forward to?
So one of the thumb rules that we typically tell investors is that when it comes to IPOs, you should be looking at companies who are unique in their businesses, unique in terms of their offering, or have limited competition. That means they are strong market leaders within their space. So the thing that comes to mind immediately when it is IPO and nowadays is the trend of tech IPOs, the so-called new tech startup kind of IPOs, the new unicorns that are coming to the space. So it's better to take bets or invest in such IPOs. I'm using the word taking bet because for retail investors, IPO allotment is finally a lottery process. You're not
Yeah.
guaranteed any allotment. But it makes sense to get into such companies. So therefore, a Zomato, which is a unicorn kind of company, which is unique, which has very limited competition, who are dominant in their space, are the lucrative IPOs you should be investing in, not really any other.
Right. Okay, I think we're once again facing some technical difficulty with the Mahantesh's line, but I hope our viewers are. Okay, Mahantesh, you're back. Please continue with your view on Zomato and other IPOs.
So I did mention that tech IPOs is something that we like and is something that investors should bet on or should it subscribe to. So that's the better way when it comes to IPO investing. In fact, post listing also some of these companies do offer better opportunities to invest into. So because many of them come with valuations which are not too expensive.
Right. You know, since you're talking about IPOs with us, I'd like you to also help our viewers who are also retail investors to perhaps five things to, watch out for or to kind of make a checklist before deciding to subscribe on any IPO? What are these things that they should keep in mind? How to research, or how to, which pages or which segments of a DRHP to sort of read into?
So one of the first thing that you should be noticing is what is this IPO for? What is the objects of the issue? There is a in the DRHP something mentioned as objects of the issue. That means there is money that is getting collected through the IPO process. Where is that money going to be utilized? Is it going to the companies for its expansion, for debt reduction, or whatever? Sometimes it is for OFS. It's an OFS. That means if the money goes to certain investors and not necessarily to the company. So the first thing out of the five things that you asked me is what is the objects of the issue that you should be looking for. Number two, you have to understand the business of the company. A dominant business is what is very good when it comes to an IPO company, because finally we chase earnings. The earnings may not necessarily be good right now. So take Zomato for example. It's a loss-making company, by the way, right now, right? But then the future prospects are so good that they will be able to erase their losses pretty fast or pretty easily in the future. So that's the second point. The dominance and the business of the company, the uniqueness of the business of the company is something that we should be looking at. The third that you should be looking at is the quality of the promoters and their experiences. And are the promoters also in similar lines of businesses? There are many uh,
Yeah,
businesses who have promoters who have related businesses being run simultaneously, and therefore there are a large number of related party transactions. So in the DRHP, you can get to the section which talks of related party transactions. That's something that you should be watching out for. Third, obviously, is valuation. Sorry, this is the fourth one. The fourth one is obviously the valuation that you should be looking at.
mm,
Many of the times, the valuation shouldn't be backward looking, it should be forward looking. You should have the ability to gauge and make an assessment that says what is likely to be earnings ahead for this company, and therefore look at the valuation. The valuations are standard numbers, P multiples, EV, EBITDA multiples, price to book multiples, etc. And fifth, which is the last one, is you have to be aware of the risks of within the IPO. So in the DRHP, there are a lot of risks that get listed by the company. Some are risks in the nature of regular business risks. Some are in the just very specific to the company. So you should be looking at risks which are very specific to that company. There could be
mm,
contingent liabilities uh, and so on and so forth. So these are the five things that you should look for an IPO. So objects of the issue, promote business quality or the business strength,
yeah.
promoters, related party, and valuation and risks.
We've already talked about metal space, so I'm not going to touch upon it, though we have a lot of questions on that. If you could give us a sense of where in the commodity super cycle are we in, and for those who want to enter the commodities and metal space right now, any particular stocks that are still attractively priced?
So I think the steel stocks are quite attractively priced. The basic steel stocks are the ones that you
Okay.
should be looking at. I did talk about how the conversion margins are becoming better for the steel stocks. Remember that US is talking of large infrastructure investments, revamping their old infrastructure. The Biden government has come up with a large package close to $2 trillion. It's between 1.6 to 1.9 trillion dollar for infrastructure revamp, and there will be a lot of steel that get required. Traditionally, China has been a consumer of great amount of steel, but now we will henceforth see US becoming a great steel consumer, which will necessarily be good for Indian companies as well.
Hmm.
So basic steel making companies are the ones that we should be looking at, and the companies who have managed to reduce their debt over a period of time. Tata Steel has done that. JSW Steel has done that. JSPL has done that. So it's these kind of steel companies that you should be looking at within the metal space.
All right. I'm afraid we're out of time, Mantesh, but before we let you go, just want to understand where will you be placing your bets as far as Q1 earnings are concerned? If you have any favorites or any stocks you would like to leave our viewers with that they should also be watching out for.
So I didn't mention we like the IT space. I did also say that the mid cap IT space is something that we like. So you should be looking at the mid cap IT space. Many of these companies also have an opportunity in terms of an impending M&A event, which is likely. So you can pick any of the mid cap IT space names. There are some that belong to the Tata group. There is Tata Elxsi, for example. There are two companies belonging, or rather three companies belonging now to the L&T family, Mindtree to LTI to LTTS.
Yeah.
You have a Tech Mahindra, for example. So these are the typical mid-cap IT names that you should be looking at. I should also talk of Infi simply because Infi is now going through this buyback activity, the on-screen buyback
Yeah.
activity that they're doing, which will mean that the stock price shouldn't correct too much. So IT is clearly the favorite sector right now for us.
All right. On that note, thank you so much, Mantesh, for joining in and for sharing your view on a host of topics, themes, and cues that investors and our viewers should be watching out for. It was a pleasure having you on board.
Thank you, Karunya.